Hello, welcome to another edition of Nucleus Investment Insights. This week we want to have a look at the oil price. So, how worried should the RBA be? It's titled. There's this idea that floating around that the oil price has been particularly weak in the face of a whole bunch of different measures, which we're going to jump onto. We've seen some pretty weak stats, inflation stats out in the US, and in terms of Australia, we've seen the RBA, talking about keeping rates up and not needing to cut. But if we do see significant price falls coming through from the oil price, then we think that we'll have to see the RBA changing its tune. So we wanted to jump in to talk about that today. I have Dave here. Hi, Dave. Welcome back.
Hello, Damien. Hello, everybody.
So, so the thing is, I wanted to let me start with the whole EV side, because I think it seems to me every time we see a weak oil price, that sort of comes back into the whole that whole theme is that EVs is what's driving it, and we've seen all this significant electric vehicle progression, particularly in China, that's really making the demand over there weak, and I think that probably. I mean, it's certainly true from a longer term perspective, but I think on the shorter term horizons, I think that's overstating the effect. So really, what we're looking at in terms of EV sales is that they make up a growing proportion of the amount of sales. So we're talking about closing in on 20%. But cars last a long time. So the average life is well north of 10 years for most cars, and closer to sort of 15 in some countries. And so what that means is, even if you're doing 20% of today's, you're still doing 80% cars that are using oil, and so that's the car sold the oil, the car that's using oil today is still going to be there in 15 years' time or 20 years' time, still using oil. And so this is a slow progression, but it is a bit of an exponential one. So as you start picking up more and more cars, what will be happening on the other end is, call it a seventh of cars or an eighth of cars, or 1/15 of cars or 1/16 of cars are dropping off every year. And they're being replaced by, and all of those are using oil, and so they're being replaced as time goes on. So, I've got that chart up to just showing that China is sort of approaching probably 50% this year in terms of the amount of electric vehicle sales, and a lot of that is government demand driven. Having said that, we've always been of the view that this is a cost issue. Is that you really need to get battery costs down to the level where people will be when they're comparing price of two cars, is that they're either not significantly different in cost, or it's only a marginal cost where people can actually look and go, yes, okay, it's costing me $3,000 or $4,000 extra to buy an electric vehicle, but I can see that I'll get that money back within a year or 2 years by cheaper driving, and we're really not there yet in most places, but you're certainly seeing signs in terms of some of the cheaper EVs coming out of China that were not far off, and the costs of batteries really have come down, and it's I think for me it's the what we've seen in the last couple of years has largely been that the cars that have been sold have been more up to the upper end, because electric vehicle manufacturers haven't been able to keep up with the demand. And so if they're looking and saying, well, I can only sell whatever it is, 10,000 cars, I've only got 10,000 cars to sell in this market, I may as well slap some leather seats and some parking assist and stuff like that, and up the price by 30 or 40% and sell to the upper end, rather than going with the basic models and selling them much cheaper. But we're sort of starting to get to the stage where that is that's coming through now. So even if you do look at these sort of forecasts and say, well, what happens if you go through some quite aggressive growth, is that we've got this, how much oil would be displaced under a range of different scenarios, and by 2030 and 2035 is what we're up. And then so these are all IEA, which numbers which we tend to think are reasonable in terms of the forecast. Not too excited about the outcomes, but not too it's not sort of too pro fossil fuel either. And so even under some of their the net zero scenarios that they run, you're talking about 15 million barrels sort of displaced by 2035, and so quite significant. Barrels of oil per day, which is quite significant in terms of the whole spectrum, but it's not. That's even that you're talking about. Over a 10-year period, so we're talking about 1.5 million barrels a day. So it's sort of like a bit over about a 1%, 1 or 2% decline in the amount of demand over that period. So it's this long, inexorable sort of push down, but it's not a massive effect that's going to jump in this year or next year. It's just going to be this slow, inexorable decline in the amount of demand. And then the other side of that is is there is the electricity available to actually power all these cars? And so when you look at those and you sort of say, okay, what's the stated policies and the pledges and all those type of stuff is it, and look at how much electricity is going to be needed by each of these regions to be able to drive all these cars. Look, it's significant, but it's not. We're talking in the realm of 1 or 2% per annum. You pick somewhere like Japan, it's 0.5% per annum. Pick somewhere like the US, it's 2% per annum. So it's significant, but it's not in the realm of no, they'll never be able to produce that much extra electricity over that time frame. So that's sort of the broad brush of it is is this being driven by electric vehicles? No, not really. It is having an impact, but that's not a sudden effect on the oil market. Dave, any comments on electric vehicles?
Well, I'm going to disagree with you.
All right. Okay.
I mean, yes, absolutely. Peak oil is incremental, and it's not here, but the marginal barrel of oil is priced out of China, and it looks to me like peak oil demand growth in China is pretty much done.
Yeah. But how much of this is electric vehicles, and how much of this is a weak industrial economy and less building as well?
Doesn't matter. It's both because
yeah. Well, that's what I'm getting to is that was my next point because they're saying then you got to go back to where does the extra demand come from?
Yeah.
And the extra demand comes from the need for.
So I'm not saying we're at peak oil globally in terms of demand growth, but I think we're on the shoulder of it, driven by China. And the thing about markets is once they get the sniff of these things, they price them well in advance. And so even if you're looking at only 1.5 or 1% drops in demand 5 years out, 3 years out, now, hard to say, then, markets start to price, the highest cost marginal producer of oil rather than based on demand or inventories or supply. So they start looking at who's going to get shaken out. And I just wonder if we're not, if we're not there, we're probably not, but if this isn't at least the specter of it, because the current oil price correction is very driven by China, where the marginal barrel is deflating, and it's the leading edge of EVs. And so if it's not peak oil right now, it's the shadow of what is to come.
Yeah, and I guess what I'm saying, but the imminent one to me is actually the weakness we've seen in Chinese both property building, because that uses a huge amount, and the industrial part.
No,
that's the imminent cause. Yeah, you've got this long-term trend that's sort of underlying it.
Absolutely, it's not just EVs by any means.
Yeah, and the other point I wanted to make on the EVs, just on these numbers. Sorry, I'll flip back to the this oil displacement. Is that I think it's important to remember as well. This isn't a linear relationship. This is not. So let's say it's going to be, their numbers are somewhere between. So by 2035, somewhere between 10 and 15 billion barrels. That's not. So let's say it's 10, just to make the numbers a bit easier. It's not going to be 1 million barrels a year. It's going to be 500,000 barrels this year, and then 600,000 or 700,000 next year. And it because each electric vehicle that comes in is going to it creates this extra demand and takes away. But then, the growth in that is not linear because it's 20% of vehicles at the moment that are being sold are EVs. By 2035, it's 80 or 90%. And so the falls in the amount of ore displaced is going to be much greater in some of those later years. And so so we're going to go through that a bit of an exponential growth in terms of that. But
sure. But I just go back to the fact that
market's going to price it in.
Yeah, they're going to price it. And if you look at where we're at, I mean, OPEC has already got 5-6 million barrels offline.
Yes, yeah, that's the next
Saudi Arabia is like 7, I think, out of 9, and non-OPEC is still growing. So when the oil market does wake up to these various peak demand factors, there's a real pro-cyclicality to it where everybody suddenly realizes, well, we can't control the price anymore.
Yes,
OPEC realizes it, and they all pump.
Yeah, well, it's a segue into supply, isn't it? So as you said, so we're in this scenario where we've got this weak demand coming out of China, supplies being held off in order to keep prices high, and prices are still falling.
The point you're making is that the weak Chinese demand growth is structural.
Yes.
Right. It's not cyclical.
Yeah.
So how long does it take Saudi to wake up to this and say, well, cripes, if this is peak Chinese demand and our marginal barrel, we can't control the price of our marginal barrel. Maybe we need to get this stuff out of the ground really fast. Take out shale. I mean, we go back to where we were in 2015, 16, 17. I'm not saying that's happening imminently. And the oil market is so big that it's really difficult to be precise about any of these numbers. But I do think we're seeing the shadow of this in weak Chinese demand, and so if it's not happening now, in the next 5 years, it is happening.
Yeah, and what you're saying though as well is it's the calculation that Saudi Arabia needs to make is, it seems to me the calculation they've been making in the past is like, okay, if we can hold 5 to 20% of our volumes off the market, and we can have an oil price of $80, then that's fine. We can take that. But once you get down to saying, well, if we're holding that money off, we're holding that volume off, and the oil price is still falling to $50 or $60, then at some point we need to say, well, now we're better off just sticking ours back on, having the price fall to 45 or 40, and making sure we're actually getting rid of our oil rather than being.
I think OPEC's
taking one for the team.
I basically think OPEC's unlikely to hold together at some point over the next 5 years. I think it'll blow up.
Yeah.
So anyway, that's not necessarily where we are now. Well, what if I just move on to the next slide?
Well, actually, before we do, the other one is Russia in terms of supply.
Yeah. So
I think we've talked in the past about the specter of, look, is the Ukraine being I guess encouraged not to take on too much in terms of Russian oil infrastructure, given the issues with inflation in the US and the whole oil price, and post-election, are they handed a bit more of a free rein? That's a potential out there. Who knows?
It is, but I mean, whatever's whatever's driving it. I mean, at the moment, there are still kind of physical draws in developed economies and things, but they're seasonally not very deep. They're less deep than they would normally be. And that seems to have upset hedge funds and others who would normally invest in oil. And so if we go to the next chart, we can see that financial holdings of oil have just absolutely collapsed, which is why the price has puked. And this means we're probably going to see a rally, okay, because we're oversold here. But is there something going on underneath it? And I think yes, there is. So we see a rally of some sort, and then we start looking for the highest cost marginal barrel. I think over the next 3 or 4 months, slowing global economy, in particular focused on China, its oil demand hasn't grown in 2 years. And is unlikely to grow in the near future. In fact, will probably shrink. So we're going to see a markets bounce around on these technicals, but I do think that we're in for some sort of kind of return, not necessarily to the depths of the sort of 2015, 16, 17 period where shale really rocked the world, but markets sniffing out the higher cost supply and looking to knock it out. So, after a bit of a rebound to clear out some of this oversold condition, I think we're probably going to settle into a much cheaper oil price than we've seen over the last few years.
Yeah, well, and this point, I guess, within a lot of the oil stuff is that within any mining or any sort of commodity operation, there's this big upfront spend, and then you've got to get that back over time. And so, if you're producing oil and your overall cost of your production is going to be $50, for example, it's your marginal cost is not $50 because you've got to spend all this money up front, and then you get it back. So your actual ongoing cost, once you've built it, your ongoing cost is probably $10 or $20. And you had all this up front that you need to get your money back on. But what it means is if your cost curve is $60, when the oil price goes to 59, you don't stop pumping because your actual marginal cost is much, much lower. And the other thing is when you do see cost curves, most cost curves you see in terms of the oil prices include government royalties. And the thing with government royalties are when the oil price falls, they fall as well. So sometimes you look at these cost curves, based on the current dollars, and sort of assume that here's this guy that talks about his costs being $60 a barrel, but actually if the oil price falls to $60, well, actually there's a big chunk of royalties in that. So now the royalties are no, there's now his cost the same oil well, same everything. Maybe the cost curve is at 55. And so, there's a lot of sort of moving parts to these, which
is a good point for iron ore investors to remember at the moment as well, or all commodity investors, because it's once that deflation takes hold, it is pro-cyclical.
Yeah, so you've got this sort of grey area in the middle almost, where you're like, okay, once the oil price or the iron oil price, whatever commodity you're talking about, once the price gets up to a certain level, people start turning on new production. But then there's this grey area in the middle where stuff that's turned on isn't going to get turned off, but new stuff isn't going to come on. So, let's take oil, for example. Let's just call it $80 $80 is the level where, all this new production starts coming on. Between say 50 and 80, actually not a lot happens because what's turned on stays on, and what's not turned on doesn't get turned on. And then, but once you start falling below whatever levels, so there can be a big gap, I guess is what I'm saying, in between the two. When you get these market shifts of like how low does the price need to go in order to start genuinely knocking out producers, it can be a lot lower than you think.
Yeah, and I would add to that the US rig count's been falling for a year. And yet production's still going up.
Yeah, it's a different one to measure that rig count, isn't it? Because the rigs have been getting so much more productive.
They have. And then there's the consolidation where you've got the majors now involved. And looking at the best fields and look
So-
to maximise their investment up front. And
So let me just sort of give that through to people for anyone who's not sort of aware of the oil market. Is one of the early leading indicators you can look at is how many rigs are actually out there drilling new wells, and that makes sense that that's a pretty good leading indicator for what's going to happen. But the problem over the last 10, 15 years is that the US wells have become so much more productive in that they used to just be, I'd get this drill to go straight down and drill up whatever oil. And then they started working out, well, actually, we can send it out laterally as well. And then we can send it out laterally in multiple directions. And then we can send it out laterally in multiple directions and sort of shift it up, 100 feet and send it out laterally in those directions. And so what it meant was these, what used to, from a single, maybe from 10 drills, 20 years ago, what was equivalent to the amount of oil that would bring up might be only 1 or 2 drills from today. And so when you look at these, but the drills might cost a lot more, or there's other factors. And so just looking at the raw numbers used to be what everyone would look at, but it's become harder to use that as a bigger measure. So that's one point. And then the other one is that within the US ones are so much more reactive than what we're seeing elsewhere. It's actually a really good feature as well. Is that and the wells last so a much shorter period of time. Within the first 18 months to 2 years, you get back most of the oil you're going to get, which might sound like a really bad thing. Wouldn't it be much better to drill a well and have it run for 20 or 30 years, like all the old and the traditional oil or conventional oil? But and so from a I guess from a user perspective, that sounds good. But actually, from wanting to be able to actually produce this stuff, it's way better to be able to do it. Being able to say, look, I can drill this well, I can lock in my prices over the next 2 or 3 years, and I know I'm going to get my money back on this thing because I've locked the prices in. And then I've got this long tail of the final 20% that might take 5 or 10 years to come out. But that's just the cream on top of it because I know I've locked in, and the investment decision is much, much easier rather than making an investment decision about a 30-year or a 40-year project that you just got no idea what the oil price is going to be in 30, 40 years. So what that's meant is, the US is way more reactive in terms of the share price. In terms of the oil price than what we've seen elsewhere.
Yeah. So just forwarding to the next chart, and here's the point I'm making about, I suppose, potential for at least immediate oversupply. And this chart's from Art Berman, who's a bit of an oil genius. And not that this chart is genius, but it's just showing that a few weeks ago we had a classic backwardation oil futures curve, which just means that future prices are a bit lower over the curve than today's, owing to holding costs and things like that, which just shows you that there's kind of a balanced market now. And over a few weeks, it's just collapsed into virtual contango, which is when you have lower prices today than you do in the future, which indicates, oversupply today versus, the outlook. And in those kind of circumstances, that's when you really get the price puking lower. And that's what we've seen. And the futures curve is really kind of telling us that right now, at least, there's too much oil and the future doesn't look a whole lot better. These things can change pretty swiftly, but that's what the futures curve has been saying in recent times. So switching to Australia, and this is where it gets, kind of super interesting. Beyond just a simple commodity. We have right now like this furious debate in Australia about inflation, or stagflation, really, where we've got weak growth and higher inflation than other developed markets, and sticky for that matter. With the RBA, the Reserve Bank, telling us all it's not going to cut rates this year, which is forward guidance, which is foolishly used before and fallen on its face. But oil is kind of trickling down under its feet here, and maybe might actually force it to fall over on its face again. If we look at oil's impact on Australian inflation is pretty full on. Like there's about CPI's made over roughly 3%. Fuel, which is just the direct impact of oil, but transport's huge. It's like 11%. So that gives you 14%, and then you've got kind of spillovers into everything else as well, because everyone's using that transport, and so it's a very significant input into cost inflation or deflation.
And it's also very it affects people's discretionary income, like
it does, yes.
because it's the part where school fees and electricity bills and things like that, they're sort of they're less often, and they're a bit more telegraphed in terms of what's happening, and in terms of putting your money aside and or interest rates and stuff like that. Whereas these are the ones where I go fill my car up, and I might have extra $20 this week, or I might have an extra $30 less next week. And it's the type of thing that flows pretty much straight through into the going, okay, well, there's extra $20. Am I going to go out and spend that on something else? Or, am I short an extra $20 or $30? Do I need to cut back on a lunch or something like that?
Yeah. Well, I put it to you, it's unlikely the marginal extra dollar is unlikely to be spent right now with sentiment so low, but it'll certainly be stimulatory in some measure. But I think the larger impact is actually disinflationary through the supply side of the economy. And you can see there's a really good correlation between Australian inflation and the oil price, just as there is just about everywhere else, quite frankly. And in year-on-year terms, we're just entering the disinflationary impact of this falling oil. And it gets pretty quickly to sort of minus 20 and 30% over the next few months. Excuse me, this is going to filter through to the monthly CPI pretty quick, and the quarterly just afterwards. Now, this does not, excuse me, just breathe something in. Sorry, Damo, do you want to
take over? Yeah, well, yeah, so I guess what the point you're making is that what we're going to see over the next couple of weeks, and let me just mute Dave shortly while he coughs along up. So what we're going to see over the next couple of inflation cycles is this negative impulse coming through from the from oil, which is going to keep the headline figures lower. And I guess that's the point, is that if let's say you look at the US numbers, which are actually US is already cycling much lower oil prices already within the numbers. I think it was sort of minus 10% or more. I think you're knocking on the 3-month annualized figures you were knocking off. So so that just means that your overall headline number is going to be lower. And then which is something that the central banks will look at and might even discount a little bit, but they'll certainly it's much harder to raise rates if you're outside your band, even if your average is within the band, but the headline figure is outside. So it's much easier to cut if you're looking at the other problems the other way around. But also they don't really measure that second and third order effects. So the fact that transport costs do fall a little bit, and then that flows into slightly lower goods prices elsewhere or services prices elsewhere. That bit doesn't really get caught in central banks' figures.
So I would just add, the main point here is that the RBA has been at war with the government over the gap between headline inflation and core inflation, and that has been based on energy. Not oil so much, more gas. But the way that's worked is because the Albanese government failed to contain the Ukraine war and all of the gas price shock that came with it. We had this huge gas and electricity price shock. And then what they've done to sort of address that is give these bill rebates directly to households, and the ABS is including that in its CPI calculations for headline inflation. But in terms of core inflation, it removes all of those volatile energy prices, so it doesn't calculate those rebates. And so the RBA is saying, well, the rebates will be temporary. We're focused on core inflation. And if you pull the rebates out, inflation's much higher. So they're saying we won't cut rates. But then you add oil to this and you get an even wider disparity between headline and core, because oil price movements are typically part of headline inflation, but they are carved out for core because they can be so volatile. So what it means is we may have a complete collapse in headline CPI in Australia, and I mean down to 2% if oil prices stay where they are by the end of the year. But core inflation will still be above 3%, and you'll have this huge gap. And the pressure on the RBA is going to become immense because, in effect, CPI will be almost falling below the target band while core is above it, which will be a crazy situation that politically the RBA will find very difficult to manage. And what we're seeing right now,
especially because we've already had a treasurer call them out,
Well, and the pressure we're seeing between the government and the RBA will explode. I mean, it'll explode. We've got an election in shortly afterwards next year, and so the pressure to cut will become unbearable, I think.
And even more so if we've seen the rest of the world cutting rates madly as well.
And we will, of course. And to be honest, I've almost no regard for this government's macro management, but it has a fair point at this stage because on two fronts, I think, because the energy rebates are unlikely to be temporary. That's the first point. They'll just sustain them. So eventually that will trickle into core inflation.
Well, sustain them unless gas prices finally fall and then they don't need them anymore. So which point they're low anyway.
Which won't happen, sadly. But as secondly, a crashing oil price is going to tip into core inflation pretty quickly. So even though it's initially carved out, you're going to see it through all of these spillovers in goods and services and reduced costs for businesses. You're going to see it have an impact pretty quickly in core inflation as well. So basically, the RBA will be forced to cut if oil stays where it is or falls further. And when I say forced to cut, consensus right now is February next year. It could bring that forward to sort of November if the oil price stays where it is. The other point to make, which Damo was just gesturing at, is the energy rebates may not be necessary if the gas price falls, and the Australian LNG exports are largely oil benchmarked, and so that, in theory, at least places downward pressure on those export prices and therefore the domestic price. But in truth, the gas cartel, the gas export cartel, just does what it needs to keep the price up. So I don't see a lot of relief on that front, but it probably won't be necessary anyway. If we're with oil with a 6 handle, then I think the disinflationary wave that comes through the economy is simply going to sweep the RBA off its feet. So, market implications for what we're seeing in oil. RBA to cut earlier if it's sustained.
Actually, sorry, before you go into the market implications, let's go to a quick sales message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Oh, yep. So back on. I just wanted actually before we go as well into that, we'll just go. There's a question in from Craig. That might be one for me. I think. What's your view on how many years worth of oil reserves remain? And just I guess a call to anyone else who wants to ask questions. Look, for me, you can run this in a number of different ways, and you can talk about if we're producing at current levels and all these things like that. The net effect for me is look. Oil prices, I don't think it's the right way to think about it in terms of how many years remain, because I do think there's almost an infinite number of years remaining, because it just comes down to price. Is that it's the question of saying if we didn't have anything else, then the oil price would go so high that whoever it only gets used for the most important needs, and so it'll get rationed out, I guess, is the using price, because we're capitalists will rule the day, and if and I guess that's what we're saying is that if electric vehicles, if battery costs come down by enough, and they probably need to maybe halve again to really make them really competitive in terms of and sort of a bit of a no-brainer in terms of switching, and probably need some more improvements again in terms of charging and speeds and stuff like that, but then you'll see the oil price tumble because everyone will be trying to get rid of as much oil as they can. And that's sort of your longer term view. But within the shorter term, it's actually going to be quite volatile in the sense that I can see scenarios where there's just not going to be enough investment in oil. And so if breakthroughs don't come in terms of battery costs and breakthroughs don't come in terms of charging, we might see oil price spike to massive levels, enough to bring new production on, but then they'll probably swing the other way, that too much new production will come on and the oil price will crash again, and you're back and forth, and vice versa if batteries fall faster or we get breakthroughs in terms of the charging faster. It's mostly solid state batteries. Then then that. So certainly don't worry about running out of oil. Yes. Anyway, sorry, Dave. On to implications for markets. So the RBA to cut earlier.
So I think the RBA is we don't know, but there's a reasonable chance that it falls on its face here and is forced to cut earlier on oil. And if it doesn't, then it's going to cut sharper and deeper. And I think deeper than markets currently pricing, about 100 basis points of easing over the next 18 months. I think it will go deeper than that. Not just because of oil, but because oil tends to benchmark commodities in general, partly because it's such a large input cost, but just part of sentiment as well. And so I'd expect more rate cuts than the market currently has priced. I don't think the Australian dollar can get overly far in this kind of environment. Probably can rally a bit further as the Fed cuts before the RBA, but given a lot of this oil weakness is coming out of China and is likely to impact commodities, it can't really get far. Very disinflationary, and so bonds recommend themselves at this point. Excuse me. Probably especially Australian bonds, which haven't really rallied that much. So you've seen a much bigger rally in the US, and the market's just not expecting rates to fall here. So I think Aussie bonds, are mispriced and therefore a better bet. And a little bit more scandalous, if this oil sell-off is sustained for a decent period, then and it does generate this disinflationary impulse, then I'm online, you and your rabbit. Then what we've seen in the Australian stock market for the last kind of 12 months or so has been this absolutely insane bank bubble With CBA trading on 24 times forward earnings and other banks sort of as a kind of late cycle play with strong immigration and high rates, giving them good margins, while mega caps globally have gone up, and that's sort of created this perfect storm for Aussie banks. But the real death knell for that is rate cuts, because excuse me, suddenly net interest margins start to contract, and the market has to take seriously the possibility of falling profits, despite rising volumes out of any rally in the housing market. So I'd be very wary of banks in this environment as well. And with CBA at 24, 25 times, it doesn't take Einstein to suggest you should take profits.
Excellent. Thanks, Dave. So just a quick reminder, we're on every Thursday, 12:30. So if you've got any questions or any topics you think you'd like to see, then drop it into the comments. You can follow us on all the major and minor podcast platforms, Spotify, Apple Podcasts, etc. And you can follow us on Facebook, LinkedIn, Instagram, Twitter, or see on our website. You can sign up to get a list of the most recent podcast posts. Thanks, everyone, and we'll speak again next week. Thanks, Dave.
Okay, thank you.